I'm going to quickly go over why people may want to get a higher interest rate than a lower one, even in this time, because you can actually get out of debt faster with your higher interest rate. So we're going to put this on the screen right now. I've got a $200,000 mortgage on the screen right now. We have a $200,000 mortgage at 6%. The payment is $1199.10, and the amount of interest that the bank wants on this thing is $231,000. A $200,000 loan. The bank wants $231,000 in interest over those 30 years. That makes the total interest paid as a percentage of principal 115.838%, not 6%. 231,000 is 115% of 200,000, not 6%. So folks, already we're paying way more interest than we need to. And listen, folks, look at this. When we break this thing down, the first payment of $1199.10, $199.10 goes to principal. That's to pay down the loan, and $1,000 going to interest. What? That is a lot of money. So we look at the interest rate, we look at our payment, but we don't look at what happens when we try to affect paying less interest. See, this program is not about how to pay loans off fast. This program is about how to pay loans off cheap. And by understanding how an amortization schedule works and how you can defeat that interest cost, you see, they constructed this thing back in 1934. You know, the way we pay back loans is 88 years old this year. 88 years old this year. And so when you make that mortgage payment, they fixed it so they can charge you a lot of interest up front on these loans. Well, if you knew how to read this, and we're going to show you in a minute, if you knew what was going on, you know that there is a weakness in the system that banking uses to charge interest. If you know what to do, you can pay the same amount of money and save the interest at the same rate that they're charging you. What? That is correct. Watch this. So when you're making this very first payment here on line number one, $199.10 to principal, $1,000 goes to interest. So if you take a look at line two, all right, so let's say you make your very first payment. You look at line two, the principal payment on line two is $200.10. We're going to make that just a little bit bigger for everybody. $200.10. Well, listen, when you hear the word prepay, prepay means giving the bank or credit card or whoever has your car loan, giving them money before the next payment is due. Okay? Any amount of money, even if it's a penny, you can figure out how much interest you're saving with that. So by making the payment on line number one, we made the first payment. Now we're looking at payment number two and the $200.10 the bank wants next month. Well, what if you gave the bank the $200.10 this month on top of your regular payment? What? You were going to give it to them next month anyway. What if you gave it to them early? All right, anytime this month, you give them that $200.10. Do you know they have to apply that to principal? You're paid down to line two, and your next mortgage payment will be on line three of the schedule for February. The March payment actually moves up one. So your payment, I want everybody to get this. Your payment is $1,199.10. And you're thinking every month I have to come up to move this along, I have to come up with $1,199.10. If I want to pay off faster, some people think I have to double up on my payments, which would mean another $1,200 payment. No, it means another $200 payment because that's the part that goes to the mortgage. The other part goes to the bank. The interest part goes to the bank. The interest part doesn't do anything for you. So watch this. So if we pay our mortgage on line 1 and we give the bank the principal payment on line 2, we drop down to line 3. So we got rid of payment number 2 for only $200.10, not $1,200. So payment number 2 is gone. And guess what else? The interest on that line is gone as well. The interest on that line is gone as well. So now here's what I need to show you. All right. If we lower the interest rate, all right, on this loan, let me show you what happens. We're going to bring up another one. So we're going to duplicate this tab. All right. Duplicate the tab. And we're going to change this interest rate to 3%. Wow, 3% on this loan. We're going to take out this payment. And now we have a $200,000 mortgage at 30 years for $843.21. Remember, this payment is $1,199.10, almost $1,200. So when we lower that interest rate, look at that payment. It's down to $843.21, and that's what we look at. But I need to show you what happens with the payment structure. Look at this. The principal payment is now $343 versus a principal payment of $200. Remember, the key to getting out of debt faster is learn how to control the principal payment. You want to be in charge of that. Have someone, like me, of course, have someone help you to determine what is the right interest rate for you with your income structure and your particular, how your bills are set up. So you can come up with a right interest rate so that you can knock off this loan in 7 to 9 years instead of 30 years to never. Watch this. So if we can pay $200.10 on the 6% loan to get rid of line 2 on the mortgage payment, look at what you have to do at 3%. Now I have to come up with $344 to do the exact same thing at the lower interest rate. So let's take a look at this. Let's say you have a little bit of money on hand, okay? You got a little bit of money on hand, and on 12 months of principal payments add up to $2,456 and a penny. Did you realize if you pay that on line 1, you're paid down to line 12 in just 1 month? $2,456 and a penny applied to this loan takes you all the way to line 12 on this amortization schedule, and you skip all the interest payments between line 2 and line 12. They are gone. Gone, gone, gone. All right? Now, watch this when I lower the interest rate, thinking I'm in a better financial position. I'm going to lower the interest rate to 3% and do the same thing. So we're going to come up with about $2,400 when I lower the interest rate. And look at that. It only eliminates 7 of the payments. My $2,400 only eliminates 7 payments instead of 12 at the lower interest rate. Do you see what I'm saying, folks? The people who own the bank know this very well. That's why they make it possible for you to get a lower interest rate. Sometimes they even actually tell you you can buy a lower interest rate. So based on this information, why would anyone buy a lower interest rate when it will actually make it harder for them to pay off the loan cheaper and faster?
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.